Good morning. Welcome to Trading Hour. It's a Thursday morning. I'm Reema Tendulkar. With me is Vivek Iyer. We're in the green, but coming off from the session highs. The Nifty today, on an intraday basis, has scaled past 23,300. So compared to that level, there has been a bit of a give back, at least in the frontline indices and even on the mid-cap end of trade, though the advanced decline ratio stays positive.
Good morning, Reema. Like you mentioned, advanced decline ratio stays positive. Mid-cap and small-cap end of the market is doing a lot better. Well, couple of stocks or couple of sectors that we could have a look at. First up has to be the pharma pack, a very sharp bounce back post steep fall that most of these stocks saw. So companies that have exposure to ARV, especially with HIV drugs, those are the ones that have bounced back very sharply. Loris is up over 7% in the session today. Stocks that are reacting to very strong results. Look at Hitachi Energy, Bajaj Finance, as well as Allied Blenders. In fact, we will be speaking to the management of Allied Blenders in a while as well. But on the other hand, some results misses. Tata Motors Voltas seeing very steep sell-off after results missed the street expectations. And one stock today, that's seen significant selling pressure, Reema, is actually Whirlpool. The parent is looking to go ahead and further trim stake. And this is something clearly that the street doesn't like. Along with that, there are also concerns whether royalty payments and technical know-how fees that the Indian entity pays to the parent, whether that will continue. So many questions as far as Whirlpool is concerned. No wonder then today the stock is down 20%. It's at the lower circuit.
Indeed, right? If the promoters had to sell, they should have sold it when the stock practically doubled, but they're back to selling it at the price that they had done in the first.
Well, they expected it to be 20% higher, but probably didn't factor in the...
But some other stocks which are reacting to numbers, one of them is Sami Hotels, where the numbers look pretty okay. There was a margin expansion. Margins went up from 31.7% to 37.3%, but the stock is reacting on the way down. So that's a stock which is under pressure. Keep your eye on NetWeb. Second day running, the stock is reacting, positively to the management, comments which they made to the exchanges, saying that this entire DeepSeek AI disruption is actually an opportunity to go deeper as other clients embrace the AI infrastructure. So there is an opportunity for the company. So NetWeb continues to gain, and KPIT Tech, that's also higher. It rallied 9% yesterday. It's followed it up with another 5% up move because the management is saying that the deal pipeline is higher by 20%. Secondly, they're also saying that deal conversions have improved on a sequential basis, and there is scope to double their wallet share with their existing clients. So those statements are taken pretty well. But let's get to Allied Blenders and Distillers. The company reported a strong Q3. The stock today is up only about 2%, but in the last 3 months, it's seen a gain of close to about 22%. Revenues have surged nearly 8%. The EBITDA has doubled, and the company saw its margins rise in the quarter gone by. Alok Gupta, Managing Director of Allied Blenders and Distillers, is now with us on the show. Thank you very much for joining in. This is Reema here. First, explain the margin expansion to us, and can you build on margins from the current level?
Thank you so much for inviting me on the show. On the margin expansion, there are three key drivers. One is sort of market share improvement in higher margin accretive markets. Secondly, continuous focus on our cost optimization program. And third is some packaging substitution that we've been doing. And these three things put together are consistently helping us improve our gross margins. To your second part of the question, will our gross margin improve? The answer is yes. As we have already explained earlier, that we are on our capex journey. We are going from being captive on ENA to 100% captive on ENA, similarly on malt, and similarly on one or two packaging items. So over the next course of 2 or 3 years, we believe there is significant scope for us to improve our gross margins.
How much in 2 to 3 years from the current 12%? Can you scale it up to 15%?
Yes, we have been consistently talking about getting to an industry parity EBITDA, which we have put at 15%, and all the work that is currently happening is in that direction. So we believe we are on the right track.
Mr. Gupta, could you help us with the volume and realization targets, number one for FY25? So Q4, what can we expect, as well as FY26? Also, you mentioned that you're looking to increase the captive ENA mix as part of your input strategy. Where is it currently, and when will it get to a total 100%?
So as we speak, we are currently at about 1/3 capacity on our ENA. We have acquired a unit in the state of Maharashtra that will allow us to add another 5% of our capacity. So that will take us to broadly about 40%. On the same acquisition, what we've done, we're going to put another 150 KL plant that gets us to about 2/3. So over the next 2 or 3 years, we will get to about 100%. So I would say exiting FY27, we will move from being 40% captive to about 100% captive.
And the volume and realization targets for 25 and 26?
The P&A share of our volumes has increased by another 2% Q3 over Q2. We have targeted to get to 50% of the P&A volume. That should also have a significant impact on our volume, our NSV realization, which are up by about 1.3%. We think the same trend will continue. On the volume side, we've grown about, my sense is we should look at early double digit in Q4 is what I think where we'll end up.
Okay. And you can maintain this double-digit growth even in FY26 in terms of volumes?
Well, the target is to get into early double-digit volume growth and maybe mid double-digit value growth. And the strategy and the brand portfolio, the way it's getting curated, is towards achieving these two KPIs. One is double-digit volume and maybe mid double-digit value growth.
And then eventually 15% margins as well in the next 2 to 3 years. So talking about strategy, you've made a strategic investment in Good Barrel Distillery, which is a premium rum brand, Rock Paper Rum. Now, you're acquiring only a 51% stake. You're paying about 9 crore. So take us through this investment. Do you have plans to raise your stake further from the current 51%? And what do you hope to achieve from this investment?
Well, the way we've structured the deal is that we are acquiring 51% with an option to buy 100% over a period of time. I think this is a brand that is coming off from very exciting startup world. We definitely want the founder CEO to be completely invested on the brand in terms of sort of building the brand and building the brand narrative, not just for India, but beyond India. This segment where this brand is operating is between 3 to 4 million cases, high gross margin, reasonable double-digit growth. So it's part of our premiumization strategy. We believe that there is only one significant brand in this segment, and I think consumers are looking for newer brands. So Rock Paper Rum has been around for a year and a half. They already have 5 very exciting variants. So we believe that we should be targeting high double-digit share from this 3-odd million cases in time to come.
Mr. Gupta, we want to understand whether do you have any overdue spending as far as the southern states are concerned. In fact, one of your peers, UBL, had significant issues with Telangana, quite a lot of to and fro over there. And also, how has the Andhra market picked up? So any overdues there, and how is Telangana as well as Andhra looking?
So first, a quick one on the Andhra market. In Andhra market, post the new policy implementation, we have gone up from about 1.8 million cases that we did last year to about a 3 million ARR. So it's been very, very beneficial for us in terms of volume growth. The entire ordering process, collection, replenishment model is working to our satisfaction. So Andhra market is running stable state, and we've grown from 1.8 million to about a 3 million case ARR. Telangana market, the good news is that we are consistently getting our payments month after month. However, there is an overdue overhang, which we think will take a little bit of time to correct. That's our outlook currently.
Thank you very much, Mr. Gupta, for joining in, and wish you all the very best. Look forward to these conversations. Get into a break. As we do that, it's time for a growth code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, an exclusive interaction which Prashant Nair had with SEBI's whole-time member, Mr. Anand Narayan. He asked him about the risks of overtrading.
Markets are all about activity, and we track it every day. But SEBI, you publish so many papers which kind of show overtrading and the risks of overtrading, and also just, the chances, the probability of actually what percentage of people make money. Just pure trading, right?
Sure.
So just talk to our sort of audience regarding that. What is your own perspective? Are you saying the more you trade, the less you make?
Absolutely, Prashant. There is plenty of research to suggest that at an individual level, precisely what you said, the more you trade, the less you tend to make. And there's a very rational explanation for this. Every trade comes with transaction costs. There's typically intermediary charges, there is taxes, there is exchange fees, and a whole bunch of things that go with every single trade. So the odds are stacked against overtrading.
Typically, nobody talks about those things. You just look at, well, you bought something at 10 rupees, I've sold it at 15 rupees, well, this is what I've made. But there is all these other things which you spoke about, right?
That's
which
right.
you must take into account.
That's right. And there is plenty of research, both at a global level as well as at a India level, which suggests that the more you trade, the less you tend to make. For instance, we did an analysis in SEBI, which looked at the activity of intraday trading. So those who took part in intraday trading, what we found is that over 70% of those people tend to lose money in those trades. In January 2023, we found that 89% of all individual traders in F&O markets tend to lose money. When we updated that research later in 2024, we found that 93% of individuals over the last 3 years have actually been losing money.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today we are focusing on gold.
Well, yes, Vivek, the uncertainty from the US markets, which is bothering other asset classes, clearly is proving to be a boon for the gold buyers there, because we are trading at an all-time highs in sense of gold for the Indian markets. We've broken above 81,000 rupees per 10 grams as well. For the international markets, we are still $30 away from its all-time highs, but the prices have been pivoting around that level for sure. So when you look at this year until now, we've gained up by 6% for the gold prices. This is after gaining 28% in the previous year as well. So there have been various supportive factors, whether it's about the interest rate trajectory. Bank of Canada also already has cut interest rates. ECB could be doing that today. The US Fed, of course, hasn't given a guidance, but the strength in US dollar index seems to be weighing slightly onto the markets here. The other part is the tariffs and the uncertainty, and that continues to support gold prices there. Well, for the Indian markets, though, there's a bit of a problem here. One, because you're looking at the gold prices on a discount of $30 to $35 an ounce. That is one, because a lot of bullion dealers and importers are trying to sell gold ahead of the budget. The expectation is, or there is a concern, that you could be looking at a reviewing of the import duty on gold, which was cut in the previous budget. So ahead of that, they want to clear a bit of their inventories. The second point is that you are looking at weaker demand because of these high volatile prices from the retail consumers as well. That has led to this discount coming in for the Indian markets there. It also has to do with the global space, where you are looking at Chinese buying slightly on the weaker side. The central bank, the Indian central bank, that is, after buying all the 11 months in the month of, in the year 2024, did not buy in the month of December. That's yet another thing that the street is watching for. But it is lower volumes as well ahead of 1st of Feb, especially ahead of our budget, and of course on what the US president does in sense of tariffs. So a bit of a volatility, but clearly gold seems to be taking all of that in sense of gains.
Thank you very much for that. Get into a break. On the other side, we'll focus on the infrastructure stocks. And what are the infrastructure companies expecting from this year's budget? Full tilt on that. Welcome back. Here is a very, very important update. Market regulator SEBI has, released clarifications on the existing guidelines which govern finfluencers. Now, SEBI says live market prices cannot be used for stock education purposes by finfluencers. If you have to use it, you cannot use live, but you have to use prices which are 3-month-old. And they will also impose a penalty, suspend or cancel registration if the rules are violated. They further add that brokers, mutual funds, investment advisors, exchanges and other market participants cannot be associated with unregistered influencers either directly or indirectly. The advisory further notes that educators should not provide investment advice without SEBI registration, and they cannot make performance claims without the SEBI permission. So these are very, very important rules. They've been in existence since, I think, August of 2024, but these are clarifications on the existing investment advisory. So we need to pay heed to that. But let's get to the budget, right? 2 days left, and infrastructure is always an important focus area.
Absolutely right, Reema. So, just before we get into a discussion with Vinayak Chatterjee, let's have a look at what exactly is the industry expecting as far as the entire infra space is concerned. Number one, government is likely to ensure, as per Morgan Stanley, a continued improvement in the quality of overall expenditure, mainly through higher capital spending directed especially towards infrastructure. A major lift to infrastructure spending, close to 3.5% of the total GDP, could create upside as far as industrials are concerned. Along with that, what they are expecting is an 8 to 10% increase in the overall allocation. This includes both budget as well as outside budget allocation. Now, along with that, what Jefferies has to say, Jefferies saying a potential disappointment, which is a little less than 15% growth in government capex, may actually be a negative as far as EPC contractors are concerned, especially names like L&T and the broader industrial sector will see some negative surprise. Now, along with that, remember, central government capex has surged almost 3x over the past 5 years already. This includes the spending as far as FY25 is concerned. Overall, a very important development for the entire infrastructure space is what we are anticipating from the budget. Higher capital allocation over there should lead to upside for industrials as well as large EPC players like L&T.
In fact, let's get in Vinayak Chatterjee, founder, managing trustee at InfraVision Foundation. So thank you for joining in. This is Reema here. The number is key, right? Last year's budgetary allocation was 11.1 lakh crore rupees. We didn't end up spending the entire amount because of the slowdown by government capex. But this year, what is the number that you're watching?
You know, just like the conversation that preceded your question, the elephant in the room question is to what extent would the finance minister use infrastructure outlays and allocations to pump prime the economy? Please remember that from 2014 onwards, the NDA government has consistently used large outlays in infra to keep pump priming the economy. Also, in the absence of any pickup in private capex in infra, or what we popularly call PPP. So in the years that have passed, you have seen 30% increases year after year in infra allocations in the budget, 5 lakh crores to 7.5, 7.5 to 10. These were all 30% increases. It is only surprising that in the last interim and final budget, that the increase was only 10%, and that took 10 lakh crores to 11.1 lakh crores, as you just mentioned. So the big question before this budget is that in the backdrop of slowing down of capex, slowing down of state capex, a slowdown of private sector capex, etc., the slowing down of consumer demand, as all of these have been documented, there is a very strong need to pump prime the economy, and no better than infrastructure, because all research has shown now that a rupee spent on infra generates 3 rupees of GDP, whereas a rupee spent on direct benefit transfer results in 90% of GDP. So nobody is disputing the fact that infra spend is the biggest lever that the finance minister and the government has to pump prime the economy. So to answer the question, what is the extent of outlay that we are looking at this year in the forthcoming budget? Now, if the government were to consistently step to 3.5% of GDP as the arithmetical norm for infra outlays, then we will get an allocation of 13 lakh crores. But 13 lakh crores will only be a 17% increase over last year. And is that sufficient? If we actually go on to levels higher than that, let's assume that the government uses infra really to get on overdrive and in a sense, take it to a 15 lakh crore outlay in the union budget, that would be an increase of 35%. And if the government feels no, the sector has matured, it can do with off-budget capital routes like InvITs and REITs and private capex and all of that, then it may take a conservative view and say only a 10% growth, and that would take 11.1 to 12.5. I would certainly bet that this budget would not go anything lower than 20%. So we could expect an infra budget between 13 to 15 lakh crores. Let's say midpoint 14 lakh crores is what I would expect. And that would be the appropriate response to the fact that there is no dispute about infrastructure pump priming the market. But that's been a lot of maths for your viewers. Over to you.
Mr. Chatterjee, one more question. FY25 first half, you saw both execution as well as tendering slow down. This is on account of the election ongoing. So there'll be quite a lot of pushing out of projects to FY26. So FY26, do you expect to see a lot more tendering activity and also any kind of monetization assets in the pipeline as far as NHAI is concerned?
Look, your first question first. There has been a slowdown in central and states, and it is popularly attributed to 3 areas: very heavy rains, a spate of elections, and insufficient capacity, political and bureaucratic, to push aggressively sanctioned projects. Now, assuming all these three factors are taken care of, I certainly see a very major push in project execution in the forthcoming quarters. And I think most analysts are also predicting that the graph is not going to go down any further. It's only going to go up. So now that was your first question. Remind me of your second question.
So a monetization pipeline as far as NHAI assets are concerned?
NHAI is anyway the best in monetization. They have monetized road assets through InvITs and TOT and others. And their monetization has crossed 1 lakh crores. So across the last few years. So if my memory serves me right, they're probably at levels of 1.25 lakh crores on monetization. That is the best that any ministry has done. I think the question really is that can other infrastructure sectors learn from NHAI's experience? For example, what has been the monetization in railways? Practically zero compared to all the talk over the years, from running trains to privatizing stations to having sections of the dedicated freight corridor on PPP mode. So railways is actually the next biggest infrastructure sector that has to monetize. The power sector already has a fair amount of private capex in play on generation, transmission, and maybe distribution is the big politically hot potato up for privatization or second licenses or whatever you have there. But if you ask me, the next NHAI is doing well. We should encourage that. And it is time for railways to step up the pace of monetization. Back to you.
Thank you so much, sir, for joining us. We'll get you once again on the show post the budget to go ahead and understand the fine print and understand who exactly benefits and what's actually slipped as far as the entire infrastructure space is concerned. Thank you once again. As we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Trading Hour. I'm intruding because we have an important bank joining us whose results we will be discussing. Indian Bank is the company in question. A very good set of numbers if you looked at the way in which the asset quality has panned out, the way in which the margins have been held on at 3.5%, in fact improved by 4 basis points. It's definitely a good set of numbers. Joining me now is Mr. Binod Kumar, the Managing Director and CEO of the bank. Mr. Kumar, good morning and thank you very much indeed for joining us. Your results make it difficult for a journalist to ask a difficult question, but I have spotted one, and that is your deposit growth. That's the only thing that has disappointed. The year-on-year growth is only 7.4%. Can you explain, is it just a temporary phase? Will it get better now with the Reserve Bank introducing liquidity steps?
Thank you, Lata. Thank you for hosting me. Lata, if you see my number, actually you have bang on the number. Deposit growth is a little bit slow. It is around 7.31%, whereas we have given guidance of 8%. But in the quarter, we have been able to raise infrastructure bond at a very good rate of 7.24% and 7.12%. So our cost of fund requirement has been met. And that's why we didn't wait for raising any costly deposit. That's why, and it was part of a strategy that we will not go for very costly deposit, and we are mindful of the cost of the fund also.
Oh, that makes perfect sense, and that's a good strategy as well to maintain your margins while raising money from sources other than deposits. The other thing that I'm not very clear about, your asset quality is overall very good. But did you notice any pain in your retail segment, especially in your unsecured loans? If you can tell us what is the percentage of unsecured loans and whether there was any pain at all there.
No, Lata, our unsecured book is very less. It is less than 1.5%. Total, it is in absolute number, it is 9,700 crore. Out of that, around 6,000 is from salaried and pension funded pensioners. So we are not seeing any stress in that.
Okay. Those were the two things that I wanted out of the way. Now let me come to what your strategy may be in the quarter going forward. Will you continue to persist with raising long-term funds, either CD or infrastructure, or will you now start going for deposits?
So my strategy will be mix of both. I will go for raising some long-term deposit also, and focus will also be on the CASA. We have a plan for also raising some infrastructure bond in the ensuing quarter, around 5,000 crore we are planning. Simultaneously, I will also focus on the increasing our CASA, which we have been able to maintain this far, and my endeavor will be to maintain that share.
Okay. Okay, yeah, you've got about 38.5% of current and savings account, which is a good number. And you've almost maintained that. You're around that ballpark quarter on quarter. What about the margins itself? Therefore, can you maintain at 3.45?
Margin in this quarter, we have been able to maintain at 3.45 and have given a guidance between 3.40 to 3.50. That has been driven by, if you see, my yield on advances has gone up by 15 basis points, whereas cost of fund has gone up by only 5 basis points. So, and going forward, if there is no rate cut, margin will also depend on the rate cut. If there is rate cut, there may be some moderation, but there is no rate cut. Our endeavor will be to maintain this margin. But definitely it will be within our guidance of 3.40 to 3.50.
Okay, got that. That is okay, averaging 3.45 only. What about cost of funds? Any guidance? Will it remain where it was in the third quarter?
Yes, we will be able to maintain cost of fund if because we will be very mindful of raising costlier deposit, and as we have also planned of raising around 5,000 of infrastructure bond, around 2,000 of tier 2 bond we may also raise during the quarter. So 7,000 of approximately, that will also be cost of fund, which can be deployed in case of need for the loan.
Okay. You know, you have an excellent ROE. So would you care to raise equity capital at all? I mean, tier 1?
As of now, we don't need actually. If you see, my tier 1 is a healthy, even capital position is 15.92%. And if I profit, which is not plot back so far, 7,962, and including March profit, I will have enough liquidity. So there is no need as such for raising any dilution of equity or going for QIP or other mode. But yes, if market conditions are conducive, then we may think of, but there is no plan as such now.
Okay. Well, now a couple of hypothetical questions, because I don't know whether the Reserve Bank is going to push for ECL, that is expected credit loss accounting, anytime soon, considering that, you know, markets are going through some kind of a churn. What is your, if they were to introduce the new liquidity rules and separately the new ECL rules, what may be the impact on your numbers? First, if you can tell us about LCR.
LCR, we have healthy LCR. On an average, we are maintaining 125%. And the impact of LCR norm, which is proposed, is around 8 to 10 basis points. So even if LCR norms come, we will be able to maintain healthy LCR coverage of around 110 to 115 basis points. Coming to ECL, ECL is a guidelines, is only draft guidelines, and let us wait for that, because many calculations are involved there, because ECL is a function of PD and LGD. If PD, we have to see how many years a regulator is prescribing, similarly LGD, what they are proposing. So talking about the impact of ECL will not be right now.
I agree, and it is anyway in a state of indecision as to when and whether it will be introduced. I guess it will have to be introduced at some point in time. Very quickly, loan growth, you've done very well quarter on quarter. Advances have grown by about 5% almost. Are you seeing any capex revival? What is your guidance on loan growth?
Loan growth, if you see, we have grown by 10%. Out of that, majorly it has been contributed by the RAM sector. Okay. So our guidance is, we are continuing with our guidance between 11 to 13%, and primarily our focus will be on RAM sector, and within RAM, my focus will be on MSME. Having said that, capex, I mean, there are some green shoots, but it is not as we have expected earlier. Let us wait and watch.
Okay. Just one number. What is the credit deposit ratio at the moment?
79.63%.
Okay, then you're comfortably off. You can, for some time, lay more emphasis on credit than advances. Thank you very much, Mr. Binod Kumar. It was a pleasure speaking with you, and all the very best for
Thank you, Lata.
Okay, well, that's the set of numbers. Actually, that's a very important revelation he made, that the deposit growth looks small, but they've raised money through infrastructure bonds. And that explains why they've been able to maintain the margin despite not raising deposits.
Thank you very much for that. From Indian Bank, we'll move to another corporate, and that's Team Lease. Ramni Datti, the CFO of the company, will join in to discuss the Q3 numbers on the other side of this break. Welcome back. As promised, let's invite the management of Team Lease on the show now. The company reported the Q3 numbers. It was a good set of numbers. The top line growth for the company came in at 19.5% on a year-on-year basis, and on a quarter-on-quarter basis, top line growth was close to about 4.5%. The company managed to grow their top line by 19.5% despite a near 7% drop in the specialized services segment. Margins were stable at 1.2%. Ramni Datti, CFO of the company, is now with us on the show. Ramni, it's a good showing, 20% top line growth. Do you have the visibility to maintain 20% growth in Q4? And what are you likely to end the year with? And what happened with specialized services?
Good morning, Rima. Yes, definitely the 20% top line growth is something that we are confident to maintain in Q4 as well as for next financial year. While we got hit with the BFSI, huge insourcing in BFSI segment for the quarter as well as in Q4, we are getting good contribution in terms of hiring volumes from sectors like quick commerce, e-commerce, retail, FMCG, and industrial and engineering. So with this, 20% top line growth is something that we are confident of. Specialized staffing, almost after 8 quarters in a row, this quarter we have finally turned net positive in headcount addition, which is a very positive sign that we are seeing green shoots in IT hiring finally, and we are seeing the momentum even from IT services in small numbers. However, we believe that it may take another 1 or 2 quarters for large volumes of hirings in IT services to come around. However, GCCs and tech hiring in non-tech companies will continue to contribute to us in IT staffing growth. Specialized staffing, mainly because of headwinds in IT services segment, we have seen the drop of 6%. However, we are maintaining the profit run rate quarter on quarter, thanks to contribution coming from GCCs. And in terms of net profits, EBITDA this quarter, we have grown about, we have been kind of flattish, mainly because of delay in EdTech. That's one area where we fell short of our own internal estimates this quarter. Otherwise, at PBT level, we have managed to get to double-digit sequential growth, and PAT also we are maintaining double-digit sequential growth.
Can you repeat what happened in the HR tech where you said it's fallen short of your own estimates? What exactly happened?
Yeah. In HR tech, our main business is the EdTech business, where we do build the universities for the student admissions and conducting online examinations for the distance degree students. So this year, because of UGC guidelines, many universities have to revisit their entire programs following the new education policy guidelines. So because of that, some of the large universities have delayed conducting examinations, because of which whatever billings we are supposed to do in end of Q2 and Q3 got deferred to Q4. On a full year basis, we are confident of maintaining 6 to 7% EBITDA in HR services. It's only a timing issue, not a loss of revenue or anything of that sort.
Ramni, you've also announced the acquisition of an 80% stake in Ikigai Enablers. Last time around, when you spoke to us, you had hinted at a couple of acquisitions in the pipeline. So what is it that you've paid for this particular acquisition? How does it help? And when do the numbers start coming into your top line?
Ikigai is a small entity, and which is currently having about 20 crore in revenue and breaking even at bottom line. So we paid about 5 crore for the 80% stake in Ikigai. But more than the consideration, we are focusing on how we can leverage our existing client relationship in India and our delivery capabilities in terms of hiring. So we will use our India team to deliver for the open positions, mainly in Middle East and Singapore regions. So Ikigai is operating in both these geographies, and we believe we will be able to utilize this opening balance and build on top of that. While for the next quarter, there won't be any contribution from Ikigai, we are confident that for the next financial year and from there on, there'll be a meaningful contribution from Ikigai, both on top line as well as profitability for IT staffing business.
Is it possible to put a number? What is meaningful in terms of a contribution?
Yeah. On top line, currently, as I said, they are about 20 crore, and with the kind of discussion and pipeline that we have for these two geographies, we are confident of more than doubling that revenue for next financial year. And profitability, this business can maintain 7 to 8% EBITDA margins, and that contribution will be presented under our IT staffing segment for next year.
Okay, one more question. Last time around, there was significant impact coming in for the entire staffing space from the budget. So this time around, what is it that you're expecting from the budget? Any specific segments that you will be looking at, and what is it that we should be watching keenly?
In fact, in this budget, we are expecting more clarity on what was announced earlier, especially in terms of employment-linked incentives with respect to EPF-related benefits and other subsidies. Because while the announcement was made few months back, so far there hasn't been any notification or any kind of guidelines on how those subsidies would be implemented. So we are expecting that in this budget, there'll be more clarity on that front. As well as on the internship and apprenticeship programs, we are expecting more clarity in terms of the subsidies or the directories to the companies on what percentage availment can be done for apprenticeship and internship.
But has there been any benefit seen in the last 1 year based on the budget announcements, or because of lack of clarity, there hasn't been any movement on it?
Yeah, as of now, there hasn't been any movement. I think we need the notification on how these programs are going to get implemented. So only then we can actually assess what can be the potential upside on these initiatives.
Okay, so going forward, FY25, FY26, could you give us a guidance in terms of where exactly you expect to end the year, including all of the acquisitions in terms of top line, margins, as well as bottom line, both for FY25 as well as FY26?
FY25 and 26.
Ramni, we can't hear you. Okay, but she did indicate that they will be looking at a 20% growth in Q4
right.
and even in FY26. Ramni, you were telling us, and even give us a margin guidance.
Yeah, because I think margins is something that the street is looking at.
Yeah. So Q4, we are expecting a very steep improvement in the margins as well as absolute profits because, as we mentioned earlier, the entire profit of EdTech cluster has been lumped into Q4. So we are expecting.
Oops, we can't get through, but Team Lees, again, just to reiterate what she said so far, 20% top line growth in Q4, confident about achieving that in FY26 too. In Q3, the margins were a bit suppressed, particularly in one of their verticals, the EdTech comes in HR Tech. If you look at the different verticals, there were some headwinds there, but all those, it just got delayed, and therefore it will be accounted for in Q4, and therefore the company is expecting a pickup in margins in Q4. But that's Team Lees for you. It's been a fairly good quarter for the company. For the market, still holding up with a gain of close to about 0.5%. The Nifty is at 23,280. It's been a stable, positive morning so far. Get into a break. We'll come back with more.
Welcome back to Trading Hour. Well, the Nifty as well as the broad end of the markets continue to build on to gains. Reliance Industries, that is the stock on the radar, trading near the day's highest point. The other stock that's doing very well in today's trading session is Mahindra & Mahindra. That stock too is seeing a sharp up move. Bharat Electronics that announced an order win yesterday, that's the top Nifty gainer. And also keep an eye out on Tata Communication. A few minutes back, you saw some news flow on your screen, and Tata Communications, on the back of that particular GPU-related news, is now trading near the day's highest point. But on the other hand, there are quite a few stocks that are seeing some selling pressure emerge, and it's the mid-cap IT that is seeing some profit booking emerging. Have a look at names like Mphasis, have a look at a name like a Coforge. Both of these stocks today have seen cuts of over 3% each. Persistent also joins the mid-cap IT space in seeing some selling pressure emerge. On the other hand, have a look at a name like Bosch. Yesterday, day first day, the results came out. Yesterday, the stock reacted to the results. But today, have a look at that particular name, almost 3% higher. And remember, this particular stock is a highly priced stock in terms of the actual price itself, almost 29,000, gaining almost 760 rupees today. But with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.